Good morning, everybody. Monday, July 15th. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can find me intra-week if something happens that I want to comment on either LinkedIn or on X. As a reminder, this presentation is prepared by me via Cantor Fitzgerald Investment Advisors. We are an SEC-registered investment advisor. Nothing in the presentation should be construed as investment advice, tax advice, recommendation for the purchase or sale of any security. All of the opinions and views expressed in this presentation are mine and mine alone and do not necessarily represent the view of CFIA's parent affiliates or even other portfolio managers here at the firm. Well, there's a lot to talk about this week, but in terms of economic data and market data, which is what we're focused on here, we had a great week. S&P 500 up almost 1%. You can see that there. Mid and small cap stocks really took the lead. Big rotation last week. You've heard me talk about the valuation difference between large and small as this bull market progresses and matures, as we now think that interest rates are likely to be coming down even as early as this year. The market believes that in September there will be a Fed rate cut. I think it's more likely November. You've heard me say that a few times. Either way, it eases up things a little bit for small and mid-cap stocks. You could see international markets participated. Bond markets rallied last week as interest rate expectations for interest rates to come down increased. And year to date, everything looks good. The only exception is long-dated treasuries, the 20-year plus treasury index down about 3% on the year. But really, just a great week for risk assets last week. And the data mostly justified that, as did the early earnings reports. Some of the financials, Delta Airlines was a little soft, PepsiCo was a little soft, but basically it looks like earnings season is going to be on track and going to be pretty good. We'll get more into it this week. Let's start with consumer credit for the month of May. The consensus estimate was that consumer credit would rise about $9 billion. It rose almost $11.5 billion. That's a positive sign. I would call that an upside surprise for the economy. Next, we heard from the National Federation of Independent Businesses, their Small Business Optimism Index, which, as you can see, has been in a downward trend since April of 2018, just slowly downward trending and hitting kind of a cycle low just a couple of months ago. But now 3 straight monthly advances, and this reading was the highest reading of 2024. I attribute that to the softening in the inflation pressures and obviously the strength in risk assets as measured by the equity markets. The number of firms said they expect the economy to worsen, actually decrease to the lowest level in the last 3 years. So that was a real positive report. On the other side, we had consumer sentiment. So that was business sentiment. This is consumer sentiment from the University of Michigan's sentiment reading. It fell to 66. The estimate was 68.5. You can see we've been for about a year on just a slow, steady downward trend there, mostly attributed to inflationary pressures. But I see those easing, as you know. I'm about to give you CPI and PPI, and I expect this number to be bottoming out soon and starting to turn around a little bit. CPI, that was the big number for last week. The June Consumer Price Index was expected to go up. Prices actually went down 0.1%. This caused a significant rally in the market because it led market participants to believe that the Fed would be more in the clear to cut interest rates because they are having success with their fight against inflation. Still, though, the CPI is 3% on a year-over-year basis, and the Fed's target is 2% core inflation. Core CPI, another measure of core, not the Fed's preferred measurement, was actually up, but it was less than expected, and that's 3.3% year over year. So this whole thing here was largely seen as positive. largely seen as increasing the likelihood of the Fed cutting rates. As I mentioned, the market thinks it's September. That's right around the corner. I still think it's November, especially given the fact that risk assets are going higher. The stock market's doing fine. Uh, if we got a couple of bad jobs reports, that could pull it forward into September. Weekly claims for unemployment, if they were to spike higher, that could pull it into September. But that's just not happening in my view. Also got June producer prices up 0.2. That was a little more than expectations, 2.6% from a year ago. The services component really is what's keeping the inflationary numbers higher. Some of the food and energy components have really come down a lot lately, and we've been waiting on and seeing. And remember, we got that ISM services number, which I talked to you about last week, which actually dipped below 50. Hard to think that there's going to be persistent inflationary pressure in services if that number stays below 50 into that contraction range. Weekly claims for unemployment have started to tick back down. Weekly initial claims fell from 239 to 222. The estimate was 235. Hard to see because this is a 4-year chart, but you can see it a little bit there coming down on the right. Similar pattern to what we had this time last summer. So maybe there's some seasonal things that haven't been accounted for in the Department of Labor's methodology. Continuing claims, which had been rising, moderated, dipped ever so slightly. So with risk assets being priced for perfection, stock markets going higher, earnings being fine, with an election coming, why would the Fed cut rates in September? I still think they wait until November. We'll see if I turn out to be right or wrong. Obviously, we all know what happened over the weekend in Pennsylvania. There was an assassination attempt on the life of former President Trump. I try to keep my comments here to economics and markets, but politics does have a significant impact on economics and on markets and on our portfolios that we manage on your behalf. And the outcome of elections certainly has an impact ultimately on policy over time, right? Congress has to create policy, president has to sign policy. It takes time, and the balance of power matters in the Congress. One president doesn't get to make tax law, as an example, or set budgets, as an example. But over the weekend, the betting market predicted, which is closely followed. There's a lot of cash that goes into this market, so it's considered pretty efficient. You can see here the probability of Trump now winning has exceeded 66%, and the probability of Joseph Biden winning is now down around 26%, as measured by people placing financial wagers on the predicted website. So it's one measurement. So therefore, it is likely to say, well, what could be the likely outcome if it's now more likely than not that President Trump is reelected to a second term? What's likely to happen to the portfolios? Well, the first thing I would say is I wouldn't want to make decisions prior to an election. Election things can change and can change quickly. We saw dramatic change in these odds here after, you can see that's after the debate, right? The debate where President Biden did not have a good night. He performed very poorly. He showed signs of aging, stopping. We all know what happened there. So we saw the odds of a President Trump rise there. And then, of course, with the assassination attempt, that rallied a lot of support for President Trump. That will wane a little bit, is my guess, over the coming weeks. And we have quite a long time before the election. But what's interesting to me as I look through the predicted is whether or not, because there's still this significant discussion about whether or not Joe Biden will be the Democratic presidential nominee. So looking at the predicted market for whether or not Joe Biden would be the nominee, a couple of weeks ago, that was at close to 90% probability. And the betting market now has that down below a 50% probability. How that would all work out and how that would ultimately impact the likely next president and how that would likely impact the House of Representatives or the Senate and then ultimately economic policy, tax legislation, infrastructure spending, rate policy, Federal Reserve appointees, it would be foolish to try to make trades in a portfolio for long-term investors. I get that there are people who are very short-term, leverage-based traders, hedge funds, and the like. That's a different story altogether. But for most of the people listening to this and watching this, we are long-term investors planning for our future retirement and making investment decisions off of short-term movements, emotional things that are happening to all of us, political winds, which change and can change quickly, probably wouldn't be a good idea. That being said, with a 66% probability in the predicted market, let's talk a little bit about what the likely attempts of a Trump administration would be. Remember, it's three co-equal branches of government. A president can't create law. That's only Congress. And Congress can't create law that's not constitutional. That's what the Supreme Court, where the Supreme Court comes into play. We have this beautiful system of three co-equal branches of government. But the presidency does have power. It has power of the bully pulpit. It has power to influence Congress. Maybe the new president will have his or her party have control of both houses and be able to really influence legislation. We don't know. But at this point, the Trump trade suggests tax cuts. We're talking about taxes according to the policy on the working class. We don't know if there would be additional corporate tax cuts because remember the tax cuts from 2017 on the corporate side are still in place. They are set to expire at the end of 2025. There's talk about higher targeted tariffs on countries with anti-competitive practices, heavy subsidies, countries that are, I don't want to say enemies, strong strategic competitors to the United States, like a China. There would be considerably less of a regulatory impact from the executive branch of government. And then I think there's this growing debate about, well, what would be the impact on debt and deficit? On one hand, the traditional Republican platform has been fiscal restraint, move towards balanced budgets, save big deficit spending for times of recession and war. But then there are other folks saying, well, no, we would go even more deficit spending. We did that with massive fiscal stimulus during the last Trump administration, but it was related to COVID. So is that likely to repeat itself or is it not likely to repeat itself? So I think post-conventions, post-nominations, post-election, and pre-inauguration and congressional seating in January, we'll probably get a better idea of whether or not the debt deficit situation improves, gets worse, depending on your view, gets bigger, it gets smaller. We'll know more about that, but I don't think we know at this time, and I think it would be premature to make trades on that. The other thing I did notice, though, is obviously with that predicted Trump trade, we saw some markets shift over the weekend. And this one here is the yield curve inversion. It's inverted when short-term rates are above long-term rates. And so the 2-year Treasury, which is this orange line, has been above the yield on the 30-year Treasury for some time. We call that a yield curve inversion. And a Trump victory is seen as re-steepening the curve, less pressure on that, probably some shorter-term rate cuts. And plus, shorter-term rate cuts are just coming anyway because inflation's coming down. But we saw that de-inverted briefly over the weekend and this morning here on Monday, July 15th. The other thing is that you would think a steepening yield curve, we all know a steepening yield curve would benefit financial stocks, right? You borrow short and you invest long. A steep yield curve accrues profitability to the financial industry, particularly banks. And as you can see, this is the S&P 500 Financials Index, really kind of started to rally a little bit after the debate because it was seen as Trump won that. And then now, since the Trump odds of victory have gone significantly higher, you see that continue to rally. But again, so almost 4 months between now and the election, and making financial bets with long-term capital, with your retirement savings, etc., probably not the wisest idea. Keep in mind, now I have, on your behalf, gone out and read both platforms. I've read the RNC platform. I've read the DNC platform. But platforms rarely become policy. They are campaign pieces. Oftentimes, they have language that is contradictory to itself within those platforms. These are pieces that are essentially sales brochures. They're designed to get votes. Whether or not any or part or all of the platform becomes policy is dependent on many more things. Most importantly, the balance of power in Congress. It will matter to our portfolios. Substantive legislation like the Affordable Care Act, like the Tax Cut and Jobs Act of 2017, like the Tax Reform Act of 1986, like the big Reagan tax cuts, changes to Federal Reserve policy and rules going way back now to the 70s and the 80s when the Fed got its dual mandate. Those are the kind of things that have impact on portfolio decisions, not in the heat and heart of an election. And remember this too, folks. I'm going to get a lot of calls today, and I've already got a couple. And I get these during as we move towards elections, and I get a lot of them post-election. People are either happy or unhappy on the outcome of the election, of course. And for those that will end up unhappy, which I would assume is half of my clients, right? And we don't know what the outcome is yet. But keep in mind that we've been through this before. And elections have impacts on portfolios. It's slow and steady, and there's never an urgency to make a trade. Keep in mind too that a lot of you forward news articles to me, and I appreciate that. Those news articles you're getting in your feed, you're finding them because of your own activity, and there are algorithms that say we want to give you what you want. And so if you read a lot of news stories about puppies, you're going to get more news stories about puppies. And if you spend a lot of time on stories about baseball, you're going to get fed more stories about baseball. And there's nothing that says the stories are necessarily factual. And I think it's just really important to focus on critical thinking, understand whether or not the stories you're reading or sending to me are likely true. Okay, enough of that. Economic data this week. We've got Empire State Manufacturing, New York State Manufacturing expected to contract. We'll get that this morning. June retail sales, import, export prices, business inventories, housing sentiment tomorrow below 50 is not particularly good, but with rates coming down, perhaps we could see that improving next month. Housing starts and permits expected at 1.314, industrial production utilization. The Fed's beige book, that's the board of directors, the FOMC book that they use ahead of the July 31st meeting. There's literally nobody's suggesting there's going to be a Fed rate cut or hike or any movement in rates at that July meeting. Initial claims for unemployment expected for the week at 228. Philly Fed survey positive, unlike the Empire State this morning, 2.9, and then nothing on Friday. Thanks for tuning in, everybody. I enjoy doing this every week. This is now coming up on 20 years of doing this. The format's changed. Now, of course, it's a YouTube channel with the video, slaying bulls and bears. We like make the complex and complicated simple and sensical. Thanks.